Governance token. A governance token doesn't give you ownership of a project's treasury or its intellectual property. Instead, it grants you on-chain voting rights over how the decentralized protocol operates. You can propose and vote on changes, and those votes are automatically executed by smart contracts, making the token's value directly tied to the health and usage of the dApp itself. Governance tokens serve two distinct purposes. For investors, they provide a direct say in how a protocol is run and a share of its earnings. For traders, these tokens often behave like volatile assets, with prices swinging based on community sentiment and voting events rather than utility. Let's look at a real-world example. SolidFlow, a DeFi lending protocol that starts with a 2% loan fee. A proposal called SLP-12 suggests reducing that fee to 1.5% for 3 months, and if you hold at least 10,000 Flow tokens, you can vote for or against the change. If it passes, the lower fee could increase loan volume, which might boost the demand and price of Flow tokens. Governance tokens let you participate in protocol decisions. First, you acquire the token on an exchange. Then, you can either delegate your voting power to a trusted community member or vote directly on proposals. Keep in mind that voting typically happens within a 3 to 7 day window, and the long-term value of your token depends on the quality of those community decisions. Governance tokens are not ownership. They don't give you equity or guaranteed cash flows. Ignoring token distribution is risky, because if 90% of tokens are held by a few people, your vote becomes meaningless. And remember, this is not a short-term trade. The price reflects how well the governance actually works, so always read proposals and join forum discussions before voting.